I think it's safe to say that it's been a pretty interesting past year and a half as a stock market investor. If you've been investing over this period of time, then most likely you have some fantastic winners in your portfolio, but those are probably sitting right beside some stocks that just can't seem to catch a break. And what's more is that while certain indexes such as the S&P 500 and the Nasdaq 100 are constantly reaching new all-time highs, well, there still appears to be more uncertainty than ever, however, in a different way than what we were experiencing back in March of 2020. Now that equity markets have fully bounced back and then some, we're seeing signs of an inflated market and headlines of a market crash that's bound to be on the horizon. And in parallel to this, we're seeing many companies posting their best ever quarters in terms of revenue and top line figures. So it's safe to say that many companies are absolutely crushing it on paper, but this doesn't seem to be enough for investors, with equity prices stalling and even declining in value. So what's really going on here? How come the broad market continues to creep higher and higher? Are we looking at an overvalued market that's set to crash in the mid to near future? And how come many of my small to mid cap companies are getting constantly beat down even though their growth on paper seems to be fantastic? Hey, what's going on everyone? It's Griffin here, and in today's video, we'll be speaking about what exactly might be causing this phenomenon in the stock market, where many positions held by retail investors, including myself, in the mid to small cap stock territory might be struggling to keep up with average market growth. While the chart of the S&P 500 looks like this, many of my stocks, particularly mid-cap tech stocks, have a chart that looks like this, with stagnation over the last 8 months and maybe even a loss in value. So with this in mind, I wanted to cover some things that I've been observing in the stock market, along with sharing some charts that I believe to be relevant. And by the way, before we get into it, I just want to mention the fact that I've been posting on TikTok. Make sure to go over and follow me. There's a link down below. I've been posting TikToks pretty much on a daily, and there's actually been some significant traction over on the platform. So if you're interested in shorter form content, make sure to go over and follow me on that platform. Alright, so before we speak about the current market environment, let's rewind the tapes back to last year in order to get some added context. Back in March of 2020, when the illness hit the world, this new reality and massive amount of uncertainty led to equity sell-offs across the board, with the S&P 500 dropping by more than 30% in record time, making it the quickest peak-to-trough recession in history. And over this period of time, there were massive levels of unemployment, companies were panicking, and all that could really be done to save the economy from an even greater period of financial distress was to step in and take action through cutting interest rates, distributing stimulus packages, and greatly increasing the flowing money supply. And although this was new territory in the modern era, and it was somewhat uncertain as to how this would permanently impact the economy moving forward once the illness was out of the way, well, it certainly had the impact of turning the stock market around, some would say in an artificial manner. Essentially, with more money in the pockets of consumers and retail investors, combined with the threat of inevitable inflation down the line resulting from a larger money supply than ever before, investors seek to retain their buying power by pouring trillions of dollars into assets such as stocks, real estate, commodities, precious metals, driving up prices of these markets to never before seen levels. And so all of this combined has now brought the stock market to a point where, based on multiple common metrics used to measure its relative value, there is high uncertainty around what lies ahead in the coming year, which is also amplified by market leaders like Cathie Wood and Michael Burry bringing different opinions to the table. And a question that I've definitely asked myself over the couple months is the following. Are modern markets in the 21st century on a new playing field than ever before? And can past situations be applied to what's going on right now, considering the technology that we have at our disposal? The modern American stock market is heavily weighted towards tech stocks, which are notorious for commanding higher price multiples. And so for this reason, even though the stock market is increasing in relative price to earnings value, well, is this a new reality for the modern market? Now, of course, most economic principles will continue to apply regardless of the period. But as time progresses, our population continues to grow, more money is printed, there are higher levels of consumption, there will always be a new level of normality and baseline reference points. And I believe that this may be something that people tend to forget when constantly trying to compare the current market environment to what's going on in the past, or what did happen in the past, I should say, meaning that this could somewhat distort our levels of reference moving forward. Back to August of 2021 though, and stocks have been acting quite differently depending on the industry and market capitalization that you're looking at. A value ratio that we've spoken about quite recently on the channel when comparing different market capitalization categories was the forward price to earnings ratio. And quite simply, the forward PE is a stock valuation ratio that you obtain when dividing a company's price per share by their forward earnings. So unlike with the trailing price to earnings ratio, which actually uses recorded net earnings by the company, well, the forward price to earnings ratio will use estimate guidance figures posted by the company. This allows investors to somewhat get a sense of how the stock is currently valued based on the projected net earnings of the company over the coming 12 months. And this can be both useful and tricky because when investors rely too much on forward-looking information to value stocks in the present moment, this is what can lead to over expectations, euphoria, and ultimately lead to a market crash. In fact, that's exactly what happened in the dot-com bubble of the 2000s, where so many companies were relying on forward-looking estimates that were unable to be met by the companies, which ultimately led to the collapse of the stock market. Now, investors tend to focus exclusively on large indexes, such as the Dow, the Nasdaq 100, and the S&P 500 when attempting to see how the overall market has been trending, but also taking a look at the PE of both small and mid-cap stocks as a whole in the market helps us to better determine the overall trends in the stock market. Just take a look at these charts showcasing the forward price to earnings ratio of the S&P 400 mid cap, S&P 600 small cap, along with the S&P 500 large cap indexes. We can see that yes, in fact, for the large cap stocks, the forward price to earnings ratio is the highest it has been since around 2000. However, with the mid and small cap stocks, which represent an extremely large portion of the American stock market, well, we're actually at a level that is in line with what we've been seeing over the past decade. In fact, even the trailing price to earnings ratio for each of these three categories of stocks is already down quite a bit from the levels that they reached in February of 2021. And with the way companies have been performing, this may very well continue to go down despite increasing market prices. In fact, taking into account the expected future growth levels of the large cap stocks in the S&P 500 index, we can see here that the price to earnings to growth ratio as of August of this year is down dramatically from the figures that we saw in early 2020. All of this to say that despite quite pessimistic growth figure estimates for the past year, many companies have been on an absolute tear, crushing both top and bottom line analyst estimates. For example, Amazon just posted their fourth ever $100 billion quarter, which is absolutely mind-boggling, yet the stock has actually tumbled since earnings, giving the company the cheapest PE value that it has seen in over a decade. So this is actually a great reminder of the fact that the economy, company performance, and company stock prices are actually each separately moving entities that don't necessarily always correlate. It's been made very clear over the past year or so that the stock market can be artificially manipulated and adjusted based on the macroeconomic climate and the decisions taken by the Feds. Case in point, this past year and a half's stock market rally has mainly been pushed by the Feds lowering interest rates along with increasing the money supply. But if, or more accurately, when the Feds decide to hike up interest rates, well, this will inevitably have an impact on cooling off both the stock as well as the housing market, because it will essentially be more expensive to borrow money used for investment purposes. And in parallel to this, when interest rates increase, investors are less prone to place their money in equities because it becomes much easier to make a baseline return on your investment just having cash parked in a higher interest savings account or other forms of fixed income vehicles. And what I believe happened here is that from the bottoms of March 2020 all the way up to the peak of the market really for small and mid cap stocks being in February of 2021, there was a lot of hype, speculation, and euphoria, especially for mid to small cap stocks, which relied heavily on forward-looking statements. So while the mega cap stocks are actually crushing figures quarter over quarter, well, with the Feds speaking about a potential increase in underlying baseline interest rates, well, this has somewhat spooked investors, especially for those growth stocks and those smaller cap stocks that do rely greatly on cheaper debt debt to continue fueling their growth. Essentially, an economic climate of higher interest rates is less favorable for growth stocks. For investors looking to continue investing in the market for the coming 20 years though, well, making sure that you're shutting out all of the noise is really the best course of action to stay focused on your plan of longer term growth in the markets. Always remember that economists and stock analysts are notorious for making bad calls most of the time actually. So making sure that you're staying the course is really the best thing that you can do. So with everything we just covered though, what am I doing with my own portfolio? First and foremost, I'm just continuing to dollar cost average every single month into my favorite stocks as well as core exchange traded funds. I'm also trying to reallocate more funds towards ETFs that I believe to be showing greater value based on how the market has been treating certain categories of stocks. For example, the S&P 400 as well as 600 indexes. In that same vein, I'm really just continuing to try and focus on a company's fundamentals and bolstering my research around the companies that I really believe in. Although it's easy to get caught up in short-term price movements, headlines, and just questioning whether or not the market right now is different than the market was 10 years ago, well, ultimately it's fundamentals and increased company earnings that tend to move the needle on market prices. Just remember that over time, if companies continue to increase their top and bottom line figures, stock prices will follow, regardless of if these are new all-time highs month after month or year after year. This is just the reality of the stock market. As more individuals continue pouring money into the stock market, values will continue to rise. Now, that doesn't mean that in that period of time over the next 20 years, we won't see some massive corrections and recessions. We definitely will, but staying the course and just continuing to invest in companies you believe in and broad index funds is really the best thing that you can do. And this is exactly why I've been speaking for years about the idea of building out a solid base of core exchange traded funds for your portfolio. While your individual positions might be in a period of stagnation or losing value, if you've been investing consistently in the S&P 500, the NASDAQ 100, and other core ETFs that I've been speaking about for years, well, chances are that those positions are still up 20, 30, maybe even 50, 60, 70% over the past year or two. So by having that solid foundational base to my portfolio, this makes me less tense as an investor and more willing to take risks on individual positions that may be more volatile, but that I see showing excess levels of upside over the next 5, 6, 7 years. That pretty well covers what I wanted to speak about in today's video. Essentially, no one ultimately knows the future state of the stock market and what's going to happen over the course of the coming year. However, do expect some higher levels of volatility, especially with larger cap stocks over the coming year as the federal government increases interest rates. This will, without a doubt, have an impact on how the market values growth stocks as well as large cap tech stocks. With that said, we're also seeing higher levels of value in other categories of stocks, such as the small and mid cap stocks that are also following a more natural and historic trend that we've seen following a bull run coming out of a recession. I continue to be a strong advocate of building your portfolio in a way that suits your level of risk as an investor, as well as holding core exchange traded funds that are going to allow you to have a more stable return on your invested capital in your portfolio, while you can then go and dabble in companies that you actually believe in based on your fundamental research. Now, if you want to learn more about stock market investing, check out the portfolio of videos that I've already made and released on this channel. We speak all the time about stocks, real estate, as well as personal finance. And on that note, I will see you in the next one.